Okay, imagine this for a moment. You have a hedge fund, right? And it's run by literally some of the smartest people on the planet, including Nobel Prize winners.
Right. The absolute brain trust.
Exactly. And then somehow, through these incredibly complex bets, they managed to nearly crash the entire global financial system.
It sounds like fiction, doesn't it? But it actually happened. That's the story of long-term capital management, or LTCM.
And that's what we're diving into today. We're really leaning on Roger Lowenstein's fantastic book, When Genius Failed, and, related material.
Yeah, it's a crucial story. And I know many people listening might have heard bits, maybe pieces about LTCM. You see it mentioned when crises come up.
Sure.
But what we want to do today is give a really clear understanding of what actually happened. What was the logic, or maybe the flawed logic, behind their strategy?
And why does it still matter? Because honestly, the lessons feel incredibly relevant even now.
They really do. So our mission, if you like, is to unpack LTCM's rise and, well, its catastrophic fall.
We'll look at their strategies, the mathematical models they used, the huge dangers of the leverage they took on,
and how unexpected market events just completely blew them up. It's a cautionary tale, really, even for the quote-unquote smartest guys in the room.
Okay, so where does this story really begin?
It properly kicks off with a guy named John Meriwether. Back in the 1980s, he ran the bond arbitrage group at Salomon Brothers.
And they were legendary, weren't they? Like the best and the brainiest on Wall Street at the time?
Absolutely, they were pioneers. And Meriwether mastered this technique called arbitrage.
Can you break down arbitrage simply for us?
Sure. Basically, it's about finding tiny differences in the price of the same asset in different places or forms.
Okay.
And then you exploit that difference to make a profit with theoretically very little risk. Buy the cheaper one, sell a more expensive one, wait for the prices to meet.
And Meriwether's team were the kings of this.
They were. A key idea for Meriwether was convergence. He had this strong belief that prices of almost identical things, securities, they had to eventually equalize, even if they drifted apart for a bit.
That makes intuitive sense, I suppose.
It does. And this belief, this convergence idea, it was absolutely central to almost everything LTCM later did.
And he was already using complex methods back then at Salomon.
Yes, that was another big thing. He was an early adopter of quantitative trading, using computer models.
The quants.
Exactly. He brought in academics, these quants, to build models that could sniff out those tiny market inefficiencies his team could then exploit. It was pretty groundbreaking, mixing high-level math with trading floor action.
So after Salomon, Meriwether decides to go it alone.
That was the vision. He wanted to take his convergence strategy, which had been so successful, and just scale it up massively, independently.
And that leads to long-term capital management.
Precisely. Founded in 1993, the core strategy was basically the same idea, just turbocharged.
Find stuff that looks cheap, buy it. Find similar stuff that looks expensive, short it.
And then wait for the price gap to close. That was the bet, over and over again.
But he needed a team, and not just any team.
Oh, he assembled what people genuinely called a dream team. It wasn't just traders. He brought in actual Nobel Prize winners.
Myron, Scholes, and Robert Merton, right, for their work on options pricing.
The very same. Plus other top academics, even David Mullins, who'd been vice chair of the Federal Reserve.
Wow. That's serious intellectual firepower.
Unprecedented, really. And you can imagine how that looked to potential investors.
I bet the roadshow was impressive.
It was dazzling, by all accounts. This was 1993. They went out to raise money.
And people lined up.
Absolutely. Even though, let's be honest, most investors probably didn't fully grasp the complexity of the math models behind it all.
But the names, Scholes, Merton, Meriwether.
Exactly. The sheer reputation, the aura of genius, it was enough. They raised $1.25 billion.
$1.25 billion, just like that.
From huge European and Japanese banks, big American CEOs, universities. Everyone wanted in.
Despite not really knowing the specifics.
Largely based on trust in the partners. So they launched in February 1994, and the financial world was definitely watching.
And did they deliver?
Oh, spectacularly. Right out of the gate, 1994, their first full year, they posted a 28% return after fees.
Which is huge compared to the general market.
Way ahead. They were doing arbitrage in mortgage-backed securities, international bonds, all sorts of complex stuff.
But you mentioned a flawed assumption lurking underneath all this.
Yes, and this is critical. Their whole worldview, embedded in their models, was based on markets being ultimately predictable. Maybe messy short-term, but fundamentally rational and prone to reverting to the mean.
They didn't really account for the crazy stuff, the black swans.
Exactly. They seriously underestimated the possibility and the impact of extreme, unpredictable events, these tail events, as statisticians call them.
Even though some people were already talking about this, like Eugene Fama and fat tails.
Right. Fama's research, even back then, suggested these outlier events happen way more often in finance than standard models assumed. LTCM's models didn't really capture that risk adequately.
But the returns kept rolling in, didn't they?
Oh, yes. 1995 was even better, a staggering 59% return. That was $1.6 billion in profit.
$1.6 billion. Incredible.
And Wall Street just fell more in love with them. Banks were tripping over themselves to lend LTCM more money.
Which brings us to leverage. This is where it gets scary.
This is where it gets really scary. By 1996, estimates suggest they had about $28 in debt for every $1 of their own capital.
28 to 1.
And here's the kicker. They were incredibly secretive about it. They wouldn't even show their full balance sheet to the banks lending them the money.
How did they get away with that?
Because they were LTCM. The geniuses, their returns were so good, banks wanted the business. And the profits just kept coming. Over $2 billion in 96. More than huge companies like McDonald's or Disney were making.
Just unbelievable arrogance, almost.
Hubris was definitely creeping in. But then, the first real cracks started to show.
1997.
The Asian financial crisis hits. Currencies collapsing in Thailand, Indonesia, South Korea. Market turmoil spreading.
And that messed with their strategies.
It did. Suddenly, markets got way more volatile. And importantly, assets started moving together, correlated in ways their models didn't fully expect.
So those little price differences they relied on for arbitrage.
They started shrinking or even vanishing, and liquidity dried up. It became harder to trade without moving prices against themselves. A liquidity crunch began.
So 97 was a warning shot.
But 1998, that was the perfect storm. It really centered on Russia. In August and September 1998, Russia defaulted on its government debt.
What he saw coming.
It was a massive shock to the system. It triggered absolute panic globally. Investors just dumped anything risky and fled.
To safety, U.S. Treasury bonds, right?
Exactly, a massive flight to quality. And this had a devastating effect on LTCM's core bets.
Because they were betting on convergence.
Yes. They expected the price gaps between risky things and safe things like treasuries to narrow. But now, treasuries were soaring in price as everyone bought them while everything else was plummeting. The gaps blew wide open.
The exact opposite of their bet.
The exact opposite. And crucially, LTCM was heavily invested in the risky assets that were falling, and often short the safe assets like treasuries that were rising. They were caught completely on the wrong side.
And they couldn't get out.
No, the liquidity just vanished. Everyone was trying to sell the same risky stuff LTCM held. There were no buyers at reasonable prices. They were trapped in massive losing position.
And the leverage.
Oh, the leverage is brutal. It magnified every single dollar of loss. By September 98, estimates put their leverage at an insane $55 for every $1 of capital.
55 to 1?
They were losing fortunes daily. Tens of millions, sometimes hundreds of millions, in a single day.
It really shows the dark side of leverage, doesn't it? Amplifies gains, but my God, it amplifies losses.
It absolutely does. Keynes' famous line comes to mind. Markets can remain irrational longer than you can remain solvent. That was LTCM in 1998.
And their sophisticated models. Useless.
Pretty much useless in the face of pure panic. The models assumed a level of rationality, of stable relationships between assets based on history. But in a crisis, fear takes over. Correlations go haywire. Things that were supposed to be uncorrelated suddenly all move down together. Their diversification just evaporated.
So the whole system was at risk now because LTCM was so big and connected.
That was the fear at the Federal Reserve. LTCM owed money to basically every major bank. If LTCM collapsed completely, it could trigger a domino effect, potentially freezing up the entire global financial system.
So the Fed had to step in.
The New York Fed, under William McDonough, felt it had no choice but to intervene, not with public money, but to orchestrate a private rescue. They called an emergency meeting, September 2nd and 3rd, 1998, hauled the heads of all the big Wall Street banks into the New York Fed building.
Must have been a tense room.
Extremely tense. The Fed basically said, look, this thing is about to blow, and it could take you all down with it. You need to bail them out.
Did Meriwether plead his case?
Reports say he did, but apparently there was a lot of bad blood. The banks were hurting too from the market chaos, and many felt LTCM had been arrogant and secretive and didn't deserve a rescue, especially from them.
But the systemic risk was too great.
Ultimately, yes, they hammered out a deal. Over a dozen banks coughed up $3.5 billion in total.
$3.5 billion.
In return, they got 90% ownership of LTCM. The original partners, Meriwether, Scholes, Merton, the geniuses. They were left with just 10%.
Basically wiped out.
Effectively wiped out.
Yeah.
Their stake was mainly an incentive to cooperate in winding down the fund orderly. Some faced personal bankruptcy too.
And just to be clear, this wasn't taxpayer money.
Crucially, no. It was a private sector bailout, organized by the Fed, but funded by the banks themselves.
So what are the big takeaways from this whole saga? The lessons learned, or maybe not learned?
Well, number one has to be hubris, right? Intellectual arrogance. Even Nobel Prize winners aren't immune to massive financial failure if they think they've cracked the code and ignore risks.
Definitely. And the limits of models, too. That seems huge.
Absolutely fundamental. Markets aren't just math problems. They're driven by human psychology, by fear and greed. Models based on past data just can't reliably predict extreme, unprecedented events.
I remember Lawrence Summers calling the efficient market hypothesis like the biggest error in economic theory history. This seems to back that up.
It certainly provides strong evidence against the strong form of it. Then there's the sheer danger of excessive leverage.
We saw that clearly. It turbocharges losses.
Makes you incredibly vulnerable when things go wrong, as Keynes said about solvency and irrationality.
And the interconnectedness, how one failure could spread.
That became terrifyingly clear. Derivatives especially created these complex chains of obligations. If one link breaks,
the whole thing can unravel.
Exactly. And then there's the moral hazard issue from the bailout itself.
The idea that rescuing firms encourages more recklessness down the line because they expect another bailout.
That's the concern. If you know there's a safety net, even a private one orchestrated by the Fed, do you take bigger risks than you otherwise would? It's a persistent debate.
And sadly, it feels like we saw variations of these same issues play out again, didn't we?
We certainly did. The 2008 global financial crisis had so many echoes of LTCM, massive leverage, flawed risk models, interconnectedness, systemic panic.
And even now, you look at things like crypto volatility or complex AI quant funds, you have to wonder,
are the lessons really learned? Or is history just rhyming, as the saying goes? It's quite sobering when you remember that even firms like Merrill Lynch wrote in their 1998 annual report about the limits of their risk models after LTCM.
Only to be caught up in similar problems 10 years later.
Precisely. Wall Street seems to have a remarkably short memory sometimes.
Okay, this is fascinating stuff, and honestly, quite chilling in some ways.
It really is a pivotal story in modern finance.
If you're finding this deep dive into LTCM insightful, maybe a bit eye-opening, we'd really appreciate it if you take a second to like and subscribe to the deep dive.
Yeah, that way you won't miss our future explorations into these kinds of critical events and ideas.
So just to kind of wrap up the core message here, LTCM, it's this incredibly potent reminder, isn't it?
Absolutely. A reminder about the dangers of thinking you're infallible, about the limits of math when human behavior is involved, and about the massive systemic risks that come with too much borrowing in markets that can turn on a dime.
Okay, so here's maybe a final thought for everyone listening to chew on. We see financial markets constantly changing, new technologies emerging, crypto, AI trading, all this stuff.
Right, the landscape keeps shifting.
So the debate about regulation, about managing systemic risk, it's ongoing, isn't it? The real question is, have we actually internalized the lessons from LTCM? Are we genuinely building a safer financial system?
Or are we just setting ourselves up, perhaps, to repeat these kinds of mistakes? Maybe in new guises. It's something worth seriously considering.
It's definitely food for thought. Hey, make sure you check out the description below. We've put together an exclusive interactive mind map for this.
Oh yeah, that maps out the key players, LTCM strategies, the timeline of events. It really helps visualize the whole complex story.
You can find that link, plus links to our other deep dives into some really compelling books right there in the description.
It's a great resource to explore this further.
Thank you so much for joining us and taking this deep dive with us today on the Inspired Podcast.